pretty good.
Yeah, it was really good. It's like, that should be the headline. The worst game is playing no game at all. Welcome to Innovation Exchange. Innovation requires curiosity and grit. I'm Elizabeth Thelen at the University of Wisconsin-Whitewater. UW-Whitewater is powered by the spirit of innovation. Every episode, we bring together the people who make that happen. Our business partners, the students rolling up their sleeves, and the faculty who bridge the classroom with real-world impact. If you want to hear how organizations are solving real problems, how students are contributing in meaningful ways, or how curiosity can drive innovation across our region, you're in the right place. So I am Elizabeth Thelen. We're here today on our Innovation Exchange podcast with Mason Cook. He's the founder of Mastercraft Ventures. Welcome, Mason.
Thank you.
Okay, so I'm just going to start right away with one of our first general questions, and then we'll talk about what you posted May 22nd of 2026. But what does innovation mean to you?
Yeah, well, first of all, Elizabeth, thanks for having me. Stoked to be here. All the questions I'm seeing for the first time / hearing for the first time, so everything's off the cuff. Innovation. What does innovation mean to me? Innovation, I'm an Eagle Scout. And so
I did not know that.
Yeah, Eagle
That
Scout.
makes a lot of sense.
So the Scout motto, and there's any Scouts out there, if I get any of these slogans wrong, it's been 30 years. I haven't thought about this stuff in a long time. But the motto or the slogan or something is, leave the campsite better than when you got there. And when you apply that to the world, leave where you are better than where it is. And I think of innovation as simply figuring out ways to leave the world better than it is.
Awesome. I love it. A little sidebar on the Eagle Scout. There is a person, Colin Flanner, and he works at the UW Milwaukee Lubar School, Entrepreneurship School, whatever that building is with Ilya. And I just saw him, but he is an Eagle Scout. And he was an intern for me at one time. And when in the interview, midway through the interview, he says, I'm an Eagle Scout. And I was like, hired. Right? Just for that motto.
Yeah,
he's amazing, and he's going at it.
That's awesome.
And a master's degree in entrepreneurship and innovation.
Yeah.
Although he's got a bent towards, I think, city planning or something like that. But let's bring us back to the topic.
Innovation looks different. Innovation looks different everywhere.
It does. May 22nd, I get your newsletter, 2026. I'm reading it. And I'm like, I call you up, I think immediately, or sent you an email. I don't know which one. And I said, we got to get you on a podcast. We got to do a webinar. We have to do something. And what you're talking about, and I'll let you explain it to the audience, but you talked about a barbell effect that's going on in venture capital. Can you kind of summarize a little bit, and then we'll dig deeper into?
Yeah, well, context for folks maybe hearing this for the first time, or hearing my voice, or who I am for the first time. My name's Mason. I'm the managing director of Mastercraft Ventures. Mastercraft is an early stage venture capital fund. We really focus on first in funding for Wisconsin-based startup companies. And if you're not sure what a startup company is, essentially it's a company designed to grow very fast. We typically invest in technology, but technology is broad, right? That can mean software, that could mean hardware or robotics or new physical products. It could mean a lot of different things. But that said, I spend my days looking at new startup companies, new ideas, new trends, and essentially trying to invest in what the future might be. And thinking about what the future might be, the reality is we're wrong most of the time. But every now and then we're correct. And when we're correct, generally that's because, we made a right bet on what the future is. And that can mean great things for the world and to Wisconsin. So we get really excited about that. And so I post regular content of industry data and information that we're seeing and how that informs our investment decisions. And for our most recent annual meeting with our investors, I did a deep dive into what the market is looking like in the world of AI. How has how has the market changed? How does this, in what way does this change the playbook for startup founders? And what I saw that was really interesting was this reality of what is a headline and what is true. Um, and if you spend any time in startup headlines, you'll see things like unicorn or billion-dollar company or SpaceX just IPO'd for $1.75 trillion.
Did you
Or
put any money in?
I bought 2 shares.
Oh, very good.
But to be clear, this is not investment
No,
advice.
I
This is
know.
not investment
Okay,
advice.
sorry.
But I bought 2 shares this morning for fun, and I was checking it up on the way here, and I've made $33.
Awesome. Well, it's two more than I bought, and I wish that I would have.
You still can.
Yeah, I know. I am watching.
So, but you have these big IPOs. They're taking all the headlines, or projected IPOs. So SpaceX, obviously, but the Anthropics and OpenAIs and all these other companies that might go public for $1 trillion. And why does it matter to go public? Why does it matter to have an exit? For investors in a private company, there's no way for them to cash out their shares unless there's a buyer. And for a private company, there's not really a marketplace to buy or sell shares like there is in the public markets. I can buy and sell a share of NVIDIA or Apple or Berkshire anytime I want. Within reason, there's a buyer, but the likelihood that that is true is very high. Whereas a private company, there's not a lot of buyers for private stocks. There's not an easy way to do it. And so for investors in private companies, they're always looking for exit events. Typically, this is an acquisition or this is an IPO.
Mm-hmm.
And so I spend a lot of times looking at, if I invest in a company, where will that company likely exit? Will they go public? Will they get a strategic acquisition offer? What will that look like? And so in our most recent essay, we looked at what is the exit market and how does that apply, or how has AI changed it? And what we saw was this interesting effect where we saw on one side billion dollar, multi-billion dollar exits. On the other side, we saw sub $150 million exits, and in the middle is fuzzy. And visually, it kind of makes this barbell of on one side you see this big weight plate. On the other side, you see another big weight plate, and then a handle in the middle. And so that's what we're seeing in the market. And a lot of that's been shaped by, in our belief, AI, where companies are currently raising less money and exiting sooner for a lesser amount of money, or they're raising a lot of capital and swinging for the fence, so to speak, and exiting for a whole lot of money. Both paths are fine. But as a founder, what's really important is knowing what game you're playing.
Oh, I love that. So I'm just going to take it to students for a moment, since we have a lot of student entrepreneurs, even though there's lots of partners and stakeholders listening. What if a student was starting something, in the tech area? We'll just make that assumption. What kind of advice would you have based on what you just said? And particularly, I'm going to take it one deeper level with AI.
Yeah. So the reality is you can build an amazing company regardless of your status, whether you're a student, whether you're a high school student, whether you're 55 years old. There is no timeline of when to start. You can do that anytime. The reality is, as an investor, I see a lot of companies and essentially pattern match on what I see. And there are a couple of types of businesses that I see almost exclusively with students that I find both hilarious, and that I find if you do anything else, I'll probably give you a harder look. So if you're a student, you're probably inclined to focus on the world around you and solve problems that are true to you. You haven't been in the real world. I'm putting quotes around that.
Mm-hmm.
You haven't been in the real world.
The traditional student.
Yet.
Too. Right.
For the traditional student, correct. And so, your life is probably, hey, where do I get food? Who do I date? Where do I park? Where do I sell my textbooks? Somewhere in that line of thinking. So the amount of, food delivery apps, the amount of where am I going to rent an apartment next year, apps or marketplaces. The amount of those types of businesses that I see are almost ubiquitous with college students. That's not bad. We've seen great companies, built around that. But innovation is not necessarily replicating what exists. It's doing something new. And so if you're a college student, I would highly encourage you to look the other way, go the other way. If everybody's going left, you go right. I saw a college student in Nebraska, this was a couple years ago, building an actuary database for big insurance companies. And this kid was like 19 years old. I was like, how the heck did you come with this idea? And ultimately we like talked to him for a long time and wanted to make an investment. And it was really, really exciting. But, the fact that he was just a college student with some earned insight around what is actuarial science. I didn't even know what that was. I was like 30 years old. So, uh, when everybody goes left, my encouragement is to go right. You asked about AI and really drilling into that. The reality is, with AI, anybody can build anything. It's so easy to build something. Knowing the right thing to build is actually the hard part. And that's where it's worth going left when everyone goes right, researching things that nobody else are, building around a problem that very few other people see, and trying to become the only person in the world building something like this.
Excellent. Yeah, because the students do. It's a great point because you do see a lot of tools and solutions kind of based on what you're experiencing, right? As a student going through life. And that could be high school or college for that matter. We just had a bunch of high school students here today. I'm just taking a little bit of back to the barbell. I want to go back to the barbell. What's going on in the middle that it seems to be so fuzzy, and I think even you might have said that it might be disappearing, or it's there, but maybe extremes.
In short, I don't know. I know what the data is.
Mm-hmm.
I don't always know the reasons behind it, but I'll do my best to maybe argue a few. I think number one, there's an emotional nature to running a company. And you might say that sounds weird. What does emotion have to do with valuation? Well, if you're an entrepreneur and you got an offer to sell, somebody offers to buy your company for, let's say, $199 million, don't you think you would be likely to say, well, 250 is a pretty round number. My ego can get behind 250. Or, I thought I'd sell for $500 million. I thought I'd sell for 500 million. There's emotion to valuation. Because the reality is that what is a company worth? Simply put, a company's worth what somebody will pay for it. But
as somebody who just sold a business last year, that is true.
Company's worth what somebody will pay for it. And a lot of entrepreneurs are surprised by that number in both ways. They could be delighted or they could be very disappointed. And so there's a lot of emotion around valuation that I do think is funny. And if you look at the stats, you could see that, the jump between $900 million exit and $1 billion exit is very significant. Probably because, well, we could, emotionally, well, if we're at 900, let's just get it up to $1 billion. But I think that's a part of it. I think the other part is, or at least one other factor could be how many companies are willing to buy something at that price. As you go up in price, as you go up in what your company's worth or what somebody could pay for it, and they actually can buy it, the number of buyers goes down significantly. Mm-hmm. I mean, who can write a check that big? The number of companies goes from thousands to 10 or 5 or 1. The one other thing I would add to that, again, it's hard to see this in the stats, and maybe it's not there. Maybe these are correlated. Is as I'm talking to CEOs in the space right now, what I'm actually hearing is their time horizon that they're planning, their strategic planning time horizon has gone from 10 to 20 years to 3.
Wow. And when you say CEOs, are you talking about the founders or the acquirers? Or
More of the acquirers.
okay,
Not every CEO is going to share this with me, and it's not like I talk
yeah,
to millions of CEOs all the time. I'm not that important. Uh, but when I get together with folks that are in my close circle that are running big companies, I'm asking that question. And the reality is, number one, they all have quote unquote AI strategies, but what they're really saying is, we don't know what we're doing with AI. We just know that we have to say we have something. Number two, they're saying everything's changing so fast, I can't plan 10 years out. I'm planning 3.
right.
And
That I
so,
think is really significant. Sounds like another
well,
essay.
well, perhaps, but from a pure, if we think about this from a game theory perspective, if
Love
you
game theory.
if
Yep.
you're a company and you're planning out 3 years and you
Mhm.
used to plan out 10 and you're looking at buying a company, how do you bake that risk of uncertainty into the price? Are you more likely to pay higher or lower when you don't know what the heck's going to happen in 4 years? Probably
Well, and
lower.
this is probably what you're seeing then,
Hmm.
is that's why you're seeing the extremes,
Yeah.
higher or lower. I mean,
Yeah.
I don't know if that's quite what you were saying, but I'm just observing that that's what's going on
Right.
also,
Right.
not just the venture capital or exits.
I hope it's clear that I have the stats. I don't know the whys.
That's fine. That we're just here to ponder and have our listeners ask themselves why.
Yeah.
They can think about it. I don't think everybody the why could have many answers,
Right.
and each person has a different motivation. But I think the observation of the 10 to 20 years, because when you think about, I'll go even in business school, right? People go on for their MBAs and they all the strategic planning is write all this down, put all this out there for 5, 10,
Hmm.
15 years. And it's like, that is like out the window. I can just write something up now
Oh, exactly.
and then tomorrow it changes.
Right. Well, and
So there's got to be some core.
mhm. And how we're kind of looking at the market right now is in 2 ways, right? So we see this barbell of billion-dollar outcomes and sub $150 million outcomes. And again, I want to be clear. It's easy to hear that and say, "Oh, a billion sounds better. I'm going to go do that." The reality is, if you've ever had a neighbor that sold their business for $10 million, you've probably thought, "Wow, my neighbor sold their business for $10 million. That's amazing." So there's no harm in a smaller exit. In fact, a lot of investors are looking for that. It's usually quicker. It's
Mm-hmm.
usually less capital intensive. The founder probably owns a lot more of the company. So everybody can walk away happy in either scenario. But when you kind of break down that barbell, how we're looking at it is in essentially a infrastructure or application path. The infrastructure here would be, hey, you're building the roads that everybody's going to drive on, right? Anthropic, OpenAI, etc. Like these are infrastructure. These are roads. These are AI tools that people can use to drive their cars. So on the other end, we see the cars, right? You have the roads, you have the cars. Infrastructure, big companies are going to invest big levels of capital into buying infrastructure because it seems like that's where everything's going. The car side, well, I don't know if I want a Toyota. I don't know if I want a Subaru. I don't know if I want a Honda. That's we don't know if this is the right vehicle, but we're willing to take a bet on it, but we're going to pay a little bit less. And so we're kind of looking at the market as you're building the roads or you're building the cars. And cars in this being sub 150 million, roads being $1 billion plus. You can make great money either way. You can make great money either way. So, but again, I think it comes down to know the game you're trying to play and be honest with yourself. The amount of founders building calendar scheduling apps that tell me they're, going to be a $10 billion company, it's interesting. The reality is it's not. And so it's okay to say, hey, we think we could build this to a $10 million exit, and here's who's going to buy us and what we have to do that. Put together a path that makes sense and just play the game that you're actually pursuing rather than convincing yourself it's something that it's not.
Yeah, I like that. Know the game you're playing. And it's not necessarily as one of those famous books, it's not necessarily an infinite game because if you're going for the exit because you have investors.
Mm-hmm.
So bringing back, you also commented in your essay about companies that raised under 10 million are exiting at roughly 9.1 times the median invested capital in 2026 versus 1.7 to 2.2 times for companies that have raised over 100 million.
Yeah. Yeah.
That is amazing, especially from your point of view, right?
Oh, absolutely.
Yeah.
Absolutely. So breaking that down.
Break that down.
Breaking that down, what when I went on to find, and you can go to our website to find all this information,
which is
mastercraftvc.com. In the top right, there's founder resources, and go to insights, and you can find this. I think the article, the essay is called Two Venture Markets.
It is.
Oh, thank goodness.
Well, let's see. And by the way, we are listening to Mason Cook of Venture Market. Let's see, Two Venture Markets. You're
okay,
right.
perfect.
Okay, sorry about that. Yep. Go ahead. So explain our gap here.
Yeah. So what we're trying to show, it's something I look at pretty significantly, is what is the ratio of paid in capital to exit value?
Okay.
And what that means is how much money is it going to take to build the enterprise value that you want? That's essentially what we're looking at. And so if you look at every company that exited over the past 10 years and divide that, add up all of the value of
and this is U.S. data?
U.S. data.
Thank you.
Yep. And so add up all the value of those exits and divide that by the amount of capital it took to make those exits happen, and you'll see what ratio there is. So we pulled the data to look at how does it compare to companies who raise less capital to more capital, and what does it take to build, a unicorn, a company that's worth $1 billion? What does it take to build a company that's worth $150 million? And what we saw was those smaller exits had a much more capital efficient path to do that. If you raise less than $10 million, you exit at 9 times paid in capital. So if you raise $10 million, you're likely to sell for $90 million. If you go down one bucket to companies that raise less than, I think it's $25 million. Is that what the chart said? I think you have it in front of you.
I didn't print out.
Oh, shoot.
Wait, no. I got it. Keep going.
Well, just for the sake of the argument, the next level is, companies that raise $10 to $25 million or $10 to $50 million.
That's a copy, so you can have it.
Oh, excellent.
I had one that printed without the graphs, and one, that's why I didn't.
Yeah, so what we have here is companies that raise less than $10 million, companies that raise $10 to $50 million, companies that raise 50 to 100, and then companies that raise more than $100 million. And based on the amount of money they raise, what was the value of paid in capital to exit?
Mm-hmm.
Companies that raise less than $10 million see a ratio of about 9.1 times paid in capital to exit value, meaning they're more, if they raise 10 million, they're likely to sell for about 90. Conversely, the next tier is about a 3.8x multiple, meaning that company that raised for $90 million, that raised 10 million, they're just as likely to sell for $90 million as if they raised 20 million. And so you're starting to see then a capital efficiency path of less money to exit value relative to companies that need more. So at the $100 million plus raised bucket, those companies are selling for about 2.2 times total paid in capital. And so what that really is starting to imply is those companies that are exiting for multiple billions of dollars, it takes a lot of money to do that. This isn't in the data, but for anybody that wants to go see that data, you can go to our website. You can see founder resources, insights, and look up our article, Two Venture Markets. But conversely, I was just listening to a different podcast the other day, and they were explaining that if you're a startup, the likelihood that you become a unicorn company is like 1%. The likelihood that a unicorn company, aka $1 billion company, turns into a deca unicorn, a deca unicorn would be like $10 billion.
Okay.
um, the likelihood you become a unicorn is like 1%. But then if you hit that threshold, the likelihood you become a deca unicorn is like 40%. And then if you hit that threshold, the likelihood that you become a centa unicorn, right, a $100 billion company, is actually like pretty significant too. I want to say it's like maybe 10 to 20%, but when we're talking about $100 billion, that's
Wow.
pretty high odds. So what you can kind of look at is, how much money did it take Anthropic to get to where they are? How much money did it take OpenAI to get to where it is? And for the listeners, that's worth a Google. See what's their total paid-in capital to current valuation ratio.
But you were going to say something, though, about what it also implies. But I was going to ask you the not fair question on some of the why.
Mm.
Why is there this efficiency? Is it something in there that they're in the technology? Like, if it would be awesome to cross-reference that with what are they actually making or building or
Mm-hmm.
problems that they're solving? Is there any
Yeah.
correlational data? Speculating there. I don't know.
It's a real good question. And I do want to qualify with one of the hard truths about venture capital is I give data on what the market says, but success lies in all the stuff that doesn't really meet the data, right? Like, why is Michael Phelps an amazing swimmer? Because he's a freak of nature. He's like 7 foot tall and he's built like a fish.
Mm-hmm.
But that silver place medalist, that's not, we couldn't name them because they just didn't make a household name. They're probably technically perfect and would meet all of the normal data. But success always lies in those outliers. Successes and big wins always, they never trend to the curve. They always outperform.
Mm-hmm.
So what does this data mean? And why do companies raising less than $10 million have a much higher exit ratio than companies that raise more than 100 million? I hate to say it. I think a lot of it has to do with the overinflated valuations and expectations that come with that. And so this really gets into know what game you're playing. And it's okay to play either game, but be honest with yourself. A company that's going to sell for less than $150 million, or let's be honest, a company that's going to sell for $25 to $50 million, their cap table is going to look very different than companies that sell for $1 billion. For a company that sells for, let's say, $50 million, investors are always looking for a big return on their risk, right? Investing in companies are very risky. And so as a reward for that risk, they're looking for, 3 to 5 to 10x or more multiple on their investment. So a company that sells for $50 million that wants 10x on their investment, you can do the math on what that valuation might be, right? That's a $5 million valuation. If I can invest at $5 million, and you sell for 50 and I'm able to keep money in, all right, $5 million, that's great. If you sell for 25, you can do the math. This is just simple, divide by 10. Now, as an investor, I like to think about the exit. As an entrepreneur, you're generally thinking about now.
Right.
And so
every day, every minute.
And so what founders tend to think is founder friendly is higher valuation, lower dilution. But what's not founder friendly are the expectations that come with that. And so the reality is a founder wants to maybe push for a $25 million valuation early on. Great. Now you're going to go have to sell that company for $250 million. Does data support that you can even do that? If not, you might have to be realistic about what it's going to take to get that round done and be honest with yourself of what's your cap table going to look like. If you're swinging for the fence, that you're building this infrastructure, you're doing something amazing, you're innovating and revolutionizing the world, like you should see really favorable terms. At the same rate, you have to live up to them. And so one of the reasons that I think this data is what it is, of paid-in capital to exit value, is because you have people early on hyping up what a company is. and investors investing in the hype of what it could become without a huge discipline around what
Mm-hmm.
valuations or entry prices might look like relative to the exit value. And so then you have a company that's incredibly lopsided that can never meet those expectations. That's just a zombie just trying to keep it along. And I hate to say that it's more realistic than
Or more common? Is it also more common?
sorry, yeah, it's a lot more common than people would believe.
Right. Okay, my mind is on fire with a lot of questions, but I'm going to bring it back to the essay because you talk about Babe Ruth or Ted Williams.
Yeah.
So for those of you who don't follow baseball, you can go Google that. Again, we're listening and talking to Mason Cook and his essay from May 22nd, 2026. So venture capital has historically been optimized for Babe Ruth outcomes. And then I had to look Ted Williams up because I'm not, I like follow casually baseball. If you were doing racing, I would know. But can you talk a little bit about what the point that you're making? And then you had a great quote from Moneyball.
So for what it's worth, I also did not know who Ted Williams was before I wrote this.
Very good.
And I had to look up who is the best, what baseball player had the best on-base percentage. That happens to be Ted Williams, who, once I learned that, looked into him, and it turns out he's a phenomenal baseball
and he's
player.
Still doesn't he still have it? Or 10?
Oh, he's great.
Okay.
He's great.
Yeah, I looked it up too.
and I think he took several years off, and so, but he was also a good home run hitter too. For those who know baseball, that wasn't me. The reality is, the point I'm trying to make is that we so heavily rely on headlines. Babe Ruth. You think of baseball? Babe Ruth. You think of basketball? Who do we think of? Michael Jordan.
I was going to say it, but if you guys can't, this is only a sound, but my eyes were like, Michael Jordan.
Oh yeah. Oh yeah.
Or Giannis.
I mean, yeah, but sure. Okay. The Wisconsin's nice, but like, we think of Michael Jordan. We think of hockey, probably Wayne Gretzky. Like, the reality is, there's these people that make the headlines. There's these companies that make the headlines.
Yes.
Again, venture capital success and startup success tends to live in these outliers, these essentially freak of natures, these people that outperform every trend. But if you're really just wanting to build a solid business, you should be a lot more like Ted Williams. The guy just gets on base. Why does he win? He gets on base. He knows how to hit the ball and gets on base. So, you can raise all this money. You can try to put together a business plan to become the next Michael Jordan, to become the next Babe Ruth. Or, hey, technically we're going to be perfect. We have a sound business plan that's built on all of this data. We can get on base.
Know your game.
Know your game. You can get on base. We can show a return to our investors. We can show a return personally. People will invest in that. If you're chasing capital, you need to learn how to fundraise. And fundraising ultimately comes down to show everybody how they're going to make money from this.
Love it. Well, and I think one of the other themes we have at UW-Whitewater too is we want the students, as well as faculty and staff, but students, when they enter into the workforce, of course, is being curious. So I'm going to take that to the headline. It's more than the headline. You have to dig deeper and be curious and understand and know the game you're playing, be honest with yourself, and then stick to it. Mm-hmm. Right? You want to like carry out your vision.
Yeah. And I would even go one step further and say under promise and over deliver.
Under promise, over deliver. I know somebody who always says
go make a headline. Make a headline. But don't tell everybody going into that's what you're doing.
Right.
I mean, if you're going to tell me you're going to be Michael Jordan, now I have to compare you to Michael Jordan.
Right.
And that's a pretty hard threshold to be. Again, I see a lot of companies. I know the typical terms. I know the typical sizes. I know what people are typically raising. In Wisconsin right now, the typical first round is about $400,000 to $500,000.
Okay. I wanted to bring it to Wisconsin.
That's what we typically see. So if a founder comes to me and, hey, first round, we're raising $3 million. Okay, do I have to evaluate you 6 times better than the average founder I see? Because you're raising 6 times more capital. Is this company 6 times better? Now I have to evaluate you that way.
And what would be your payoff be in the exit?
Yeah, I mean,
Given your other
that would
stats
change.
that
That
you're
would
pointing.
I mean, it would
Yeah.
have to be a bigger exit.
Mhm.
But my point is, if you're not aware of what the market is, and if you're trying to compare yourself and claim, hey, we're going to be Michael Jordan, I have to compare you to Michael Jordan.
Mm-hmm.
If you say, hey, this is what companies in our world typically raise, this is what we're typically seeing, and we're really just right down the fairway here, it's a lot easier to diligence a company like that, and you're probably more likely to get some investor interest.
So excellent. You make this point in the essay too: is choose your game carefully. Choose your game carefully.
Mm-hmm.
All right, I'm going to take you on a little bit of an off ramp.
Sure.
Okay, here's a headline I just saw on LinkedIn. And because Whitewater, Wisconsin, we are really fusion energy coming out, all research and spinouts coming out of UW-Madison, but Whitewater is also involved. But this Helion Energy
Hmm.
just announced and they're not from Wisconsin. That's not the point. $465 million Series G investment to accelerate the commercial deployment of fusion, scale manufacturing capacity, and expand the company's ability to deliver clean electricity to customers. Did you see this headline? Do you have any comments on it?
No, I didn't
And
see it. Wisconsin's pretty heavy into um, fusion energy as well, which is really cool. But my quick comment on that, based on this conversation, is number one: are they building infrastructure? Are they building vehicles?
yeah,
These guys are building infrastructure, and
right.
it's going to take a lot of money to do something like that, and the payoff's going to be great. And at the end of the day, if they're right about their bet on the future, I think it leaves all of us in a much better place. I want to see companies like that be successful. I really hope it will. Um, but they're obviously playing a Babe Ruth game. They're
Mm-hmm.
building infrastructure. It's going to take a lot of money to do that, and they should be able to see a very high payoff when it happens.
Excellent.
We
Thank
want
you.
to see more of that.
We want to see more. But I'm going to go back to your point, and then we'll kind of round this out is know your game. Maybe it's not Babe Ruth, it's Ted Williams, right? And so people can look that up. Other advice, I guess, last kind of thoughts for any inspiring entrepreneur startup.
Yeah,
And you can be as general as you'd like, and maybe I'll have a follow up.
I think when you're coming out of college, starting your first company, or just like you're coming out of college, you're 20 something years old in most cases, the world's ahead of you. You know, founders get to a point, they'll start a company and they'll think, oh, I'm going to do this is my legacy, this is the rest of my life. Well, 99 times out of 100, everybody graduating college has not worked a single job for 5 years straight. It's very uncommon to do that anymore. And it's probably uncommon that you're going to have interest in that business for 5 years straight. Um, and so my suggestion and advice is take your career on 5 to 10 year arcs. Going into the arc, you're going to have a lot of energy on this. I always break it down to the Dunning-Kruger effect, which you can Google and see what the Dunning-Kruger effect is. But it essentially depicts and explains the difference between competence and confidence. When you have low competence in something, you're ironically the most confident that you can do it. And so, you kind of think of a roller coaster and you're going up the swing of this uninformed optimism because, hey, I read some Wikipedia, I watched a few YouTube videos. I know everything about this space. And I'm so confident I can do it. It's going to be so great. And then you kind of crest that roller coaster and you start going down with what we call informed pessimism. Oh, I thought I knew all this, but then I started reaching out to people, and it turns out we're not that unique. Or I can't get a meeting, or hiring a team or bringing on a co-founder is so hard, or I didn't know how to build this, or so on, so on, so on. You start doing stuff, and the link between theory and reality are different. At the bottom of that is, you can either crash and burn and, hey, this isn't going to work out, or you crust, turn that the bottom of that roller coaster, and you start going up with informed optimism. And that's a great place to be. But I like to suggest to founders that your arc, you should look at every business and everything as a 5 to 10 year arc of how much energy do you have towards this idea. And after 5 years, do I still have that same energy? If not, it might be a good time to pass the buck. Bring on a new leader, sell the business. If you're still energetic about it, if the growth's still ahead of you, keep at it. But the reality is, you're graduating college, you're in your early 20s in most cases. You probably aren't going to stay with this business, this idea, this thing for 50 years. You probably aren't. You could, but you might not. And so the reality is, your first business, my suggestion is try to be as quick to an exit as possible, learn a whole lot from it, and let the next 2 or 3 businesses that you make, let those be legacy.
We have a few of those students that have done that here. But can you just extend what you said, but focus on faculty? Because yes, they're here, but they're in all, faculty as well, come up with research and innovation and try to spin out a business. What kind of thoughts do you have for them? Are they kind of similar? Because they've been working at a job, right, for a long time. But now we have a whole different set of challenges.
If I were faculty and I was coming up with ideas that I wanted to get out there and have some ownership in, right? I think, again, it comes down to the cap table. It comes down to what's a company worth, what somebody's going to pay for it. You might be surprised by that in a pleasant way. You might be discouraged by that. But if you have IP that's sitting on the shelf,
intellectual property.
Sorry, if you have intellectual property that's sitting on the shelf and you want somebody to take it over and run it, you're not going to have any success unless you give up the vast majority of that. Unless you're going to quit your job and run the company.
Which is know the game you're playing.
Know the game you're playing.
What do you want to be doing?
What do you want to be doing? Know the game you're playing. If you're planning to have somebody else run that business, you need to be prepared to give up the vast majority of control of that. Otherwise, why is that person doing it?
Yeah. No, that's good. That's good.
And so, yeah, I think there's so much opportunity just sitting on the shelves here. At Whitewater, at so many universities. And we need to incentivize young entrepreneurs or, inexperienced or very experienced to commercialize that intellectual property. And the reality, again, going to game theory of this, like the reality is it's sitting on the shelf. It's worth nothing. It's worth nothing. Let's say you give somebody 90% of that business, you retain 10% as an advisor, and they turn it into something.
Right.
Now it's worth something. You have 10% of that. That's awesome.
Again, is a choice, right, that you're going to make and to think that through. There's a lot of programs, obviously probably everywhere in the U.S. and world, but I'll stick to Midwest and Wisconsin, that are trying to look at, let's get the IP off the shelf, match up a founder. We're part of this in one of them. And then, let's see if we can accelerate that business model. And then ideally, Mastercraft invests in the first round.
Yeah, that's what I'm talking about.
That's what we're talking about.
That's what we want to do.
All right. So we just want people to be curious. I'll let you get the last word on some sort of things that you would like us to think about in terms of knowing your game or choosing your game.
The worst game to play is not any game at all. What we really need is more bees making honey. I like to use that analogy a lot, but we talk a lot in the startup world about investors and accelerators and startup orgs and service providers and community builders and all that stuff. Those people don't make honey. You know who makes honey? Founders make honey. So go play the game. Go make some honey. Become a bee and make honey. That's really the only thing that matters. So if you have an idea, you want to talk about the idea, you have great resources ahead of you here at Whitewater and in so many other places, use them. Become incredibly resourceful, be an aggressive sponge, go learn things that nobody else seems to know and figure out how to turn that into a business. And we'd love to support you with that.
That is one of the number one things we talk about is you say making honey and being, we say be curious on the Innovation Exchange. So go chase it, not just be curious, but go get it.
Yeah.
And not be in the surrounding, just looking on the sidelines, but jump in the game. I love it. The worst game is no game at all.
That's right.
All right. Thank you, Mason Cook.
You bet. Thanks for having me.